Hi guys, this is Bilal and welcome to my YouTube channel Forex Billionaire. Before the start of the video, I would request you to go on the bell icon, subscribe the channel, like the video, and if you like the video, please share with your friends and family. And for those traders who want to start the trading and don't know which broker they want to choose, which will be the favorable broker for them in form of swap charges, in form of spread, in form of commission. So I have given the links in the description, the best brokers which I'm using since last many years, which I can recommend it to you. I have given the links in the description. So go in the description, click the link, and you can make your real account on those brokers. So today we have a topic of chart patterns. So in my last video, we learned about some reversal chart patterns, and today we will continue that topic of reversal chart patterns. And today we will complete this reversal chart patterns topic. So I will show you some other examples of reversal chart patterns. So traders, here you can see this is an example of bearish head and shoulders. Basically, it is bearish reversal pattern. Here you can see the market was in uptrend, then they form a left shoulder. This will known as left shoulder. We can say it as left shoulder. Then after hitting the neckline or the support line, the buyers push the market towards up, and this we can say it as a head of this head and shoulder pattern. This was the left shoulder, and from the neckline the market push up and it formed a head. Then after hitting the neckline or the support line again, the market form a right shoulder. So this is known as head and shoulder pattern. This is the left shoulder, this is the head, and this is the right shoulder. And eventually market will break down the neckline and goes down. We will look after this example on the live chart as well. I will explain you in detail on the live chart. Here you can see this is an example of bullish inverted head and shoulder. It's a totally opposite of the bearish head and shoulder. The market was in downtrend. The market form a left shoulder, then market form a head, inverted head, and then market form a right shoulder. Eventually market will break this support or neckline and will go up. We will look after this example of inverted head and shoulder on the live chart. This is an example of rising wedge. This is also a reversal pattern. Here you can see the market was in a form of wedge, and the market was consolidating in the wedge. So you can see the market was making higher highs and higher lows. This was the higher high and this was the higher low. This was again the higher high, higher low, higher high, and higher low, higher high, and eventually market will break down the lower trend line of this wedge and will go down and will make the low and then higher low and then lower low. So this pattern is known as wedge because of it shaped like a wedge. And this is also a reversal pattern because market was in uptrend and eventually break down and will go further down. This is an example of falling wedge. You can see the market was in downtrend, and this is the upper trend line and this is the lower trend line of a falling wedge. Wedge we say because of the shape of this chart pattern. The market was making lower low and lower high, lower low, lower high, lower lows, lower high, lower lows, and eventually market will break through the upper trend line or through the wedge, and it will make a high and then high low and high high. So this pattern is known as falling wedge, and it's the bullish reversal pattern. Now we will see the examples on the live chart as well. So guys, here you can see This is an example of bearish head and shoulder pattern. I spot this example for you and I will explain you in detail. So market was in uptrend. Here you can see the market was in uptrend. Then the market pushed by the sellers toward downward and market hit the support line or neckline. Okay, there was buyers on in this area. So the buyer pushed the market toward up and it was going nicely, but then again the seller push the market towards downward and it make a shape of head. This was the shape of left shoulder. You can say that this is the left shoulder. Then the market will push up higher and it makes the shape of head. So left shoulder and head completed. Then the market comes back again second time to the same point or the support line or the neckline, and again the market get pushed up from there, and then market make a right shoulder. After hitting two times to the neckline or the support line, the third time, then when market tested that support line, it breaks down this support line. This was the neckline or the support line, we can say that. So the market was in clear uptrend. The market tried to break through the support line twice, but it couldn't. So it make a left shoulder, market goes up, make a head, and then market make a right shoulder. And the third attempt to break down to the support line or the neckline, the market succeeded this time and it break down the support line or the neckline. Okay, so you can see this is a clear example of head and shoulder. This is the left shoulder, this is the head, and this is the right shoulder. The head will be above both of the shoulders, but the neckline or the support line of all shoulder, head and right shoulder will be same. Sometimes it can be tilt towards the right side or the left side. A minor difference can be okay, no problem about it, because you cannot get 100% chart, because it's different from drawing a chart or having a chart on a live chart, because it's different when you go in the into the paint box and draw it, and while you are finding out on a live chart, it's a bit different. But here you can see it's almost the neckline of is the same, the support line is the same. So the market tested one time here, second time here, and the third time when the market tested, it break down. So here you can see the market break down from the neckline or the support line. So where you should take the entry, because this is the bearish reversal pattern. The market was in uptrend and now market broke down to the neckline or the support line. So you have to wait for retesting of this support line. This is a support line. Here you can see this is a neckline or the support line. You have to wait for the retesting of this neckline or the support line. Here is the retesting. Here you can see the market retested the neckline, and here you can take the entry of your selling orders. And where you should put your stop loss, you will always put your stop loss above the right shoulder. You can put few pips above the high of the right shoulder. And what should be your target? Your target should be, or your take profit should be, regarding the high of this head. Approximately this will be 150 or 200 pips. So you can set your target around 1/2 or 1/3. You can take how much is the length of this head, and you can see how much pips are there in the head, if 150 or 200 pips around. So you can put your target accordingly. So it will be around 1/2 to 1/3 risk reward ratio, that would be. And honestly speaking, this is the most effective chart pattern I have ever used in my technical analysis, because 80 to 85% whenever you see a head and shoulder pattern, you will get a positive result. Now we will see a second example of inverted head and shoulder. So traders, here you can see this is an example of inverse head and shoulder, inverted head and shoulder. So this is a bullish reversal pattern. The market was in downtrend. Okay, the market hit the neckline, the resistance line. Okay, after hitting the resistance line, the sellers were there. The seller pushed the market down, and the market makes a formation of a head. First, the market makes a formation of a shoulder, left shoulder. Then sellers from the resistance push the market down, and market form a head. After retesting, the second time market retest the resistance line or the neckline, and it failed again to pass it, and the sellers were strong there. The seller pushed the market down, and market form a right shoulder. You can see this is the left shoulder, this one is a head of, and head will be always in inverted head and shoulder, head will below the left shoulder and right shoulder. And you can see after formation of head, the seller pushed the market down and it form a right shoulder, and eventually after formation of right shoulder, the market break through this neckline. This is the neckline or the resistance line where the left shoulder, head and right shoulder tested the market to break through it. And here you can see the market break through the neckline, and after breaking, the market will come and retest it. Here you can see market retested the resistance line. Now this neckline has become support. Before, previously it was the resistance, and once it break through, now for the price, this neckline has become a support. Now market will act this neckline as a support. Now you can see after retesting or testing of the support, here you can take the entry of the buy because it's a bullish reversal pattern. At this point, you will take your entry, and where should be your stop loss? Your stop loss should be below the right shoulder, few pips below the low of the right shoulder. And where should be your target? As I told you, the length of this head should be your target, approximately 150 to 170 pips it would be, or you can take 1/2 or 1/3 risk reward ratio target. Now we will move on to our next pattern, which is falling wedge and rising wedge. Here you can see this is an example of rising wedge. The market was in continue uptrend. Okay, the market is making higher highs and higher lows. This is the upper trend line of the wedge, and this is the lower trend line of the wedge. And you can see the market is moving up, and this pattern is in a form of wedge. That's why we call it we known as wedge, and because it's going upward in upward direction, uptrend, that's why we call it rising wedge. Here you can see the market is making higher highs. You can see here higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low, higher high, and eventually the market will break down and will make a low and then lower high and lower low. Approximately in a wedge there could be 5 or 7 touching points. We can count it 1, 2. Here you can see this one is a fake breakthrough or breakout. This is the fake breakout. Sometimes it happens, it seems like it break through it, but it did not, because the volume might be, sometimes the volume is low, and sometimes due to some news, impact of news and manipulation, sometimes it happens. So I told you that you cannot get 100% chart like you see in different books or in different PDF material. You see the the shape of the charts are just like perfect. You will not find the perfect chart when you come on the live trading section. So while you're looking at the live trading charts, so sometimes these type of things you will see. So this is the fake breakout. So here is the 1 point, second touching point, third, fourth, fifth, sixth, seventh. This is an ideal rising wedge form. When you get the seventh form, you will get the seventh touching on the upper trend line, and after that the market will break down this rising wedge. Here you can see where should you take entry. As I told you, once the market break down to the lower trend line, break through it, and after breaking through it, it will retest. Here you can see the market retest it. Here you will take the entry for the sell. Where should be your stop loss? Your stop loss should be above the upper trend line, the high of the upper trend line. This will be your the previous higher high which market has formed. You will get your stop loss above, few pips above that higher high. And where should be your target? Your target should be the height of this wedge. You can count it, how many pips are there, or you can take risk reward ratio 1/2 or 1/3. That will be ideal for rising wedge. And this is the reversal pattern. This is the bearish reversal pattern, because market was in uptrend and it breaks down and then it goes lower and hit the target. Now we will see our next example of falling wedge. So guys, here you can see this is an example of falling wedge. And guys, I always do my hard work to show you these type of chart patterns. I tried my best to give you the best example. Otherwise, it's very easy to go on any website and get the PDF book and to show you on the PowerPoint. It's very easy, but I always try my best to give you the live examples. So once you go on your live chart, you can find that on your live chart easily as well, because there's so many difference between a book and once you go for the live trading. There's a lot of difference. So here you can see the market was in clear downtrend. So this is the first touching of the lower trend line. It's the 0.1, the 0.2, the 0.3. This is the lower trend line of the wedge, and this is the upper trend line of the wedge. You can see the market is when making lower lows, lower high. This is lower low, lower high, lower low, lower high, lower low, lower high. And eventually the market, after retesting the lower trend line more than 3 times, the market will retest its upper trend line, and eventually in the fourth attempt it will break the upper trend line. And here you can see the market has break through the upper trend line of the falling wedge, and this is the sign of trend reversal. So the market was in bearish trend and the market break through the upper trend line. It's the bullish reversal pattern. Here you can take the entry once the market come and retest the lower trend line. And once the market retests the lower trend line, upper trend line, once the market, and here you can take the entry once the market break through the upper trend line and again retest the upper trend line, which now become a support. And here you can take your entry for the buy. And what should be a stop loss? Your stop loss should be below the lower low the market has made previously, and your target should be the height of this falling wedge, or difference between this upper trend line and the lower trend line, the difference of the point. So you can take risk reward ratio 1/2 or 1/3. So guys, I hope you like the video. So our reversal chart patterns are now completed. In our next video we will learn about the continue chart patterns, and then we will learn about the neutral as well. So go to the description. I have given some links for the brokers, which are, you can say that I have confidence on those brokers. So they have very less commission, less spread. Some brokers have no commission and no spread as well, no spread charges. So you can go and you can make your account there. I hope you like the video. Please share the video as well and stay tuned for the next video.